my premises about money. I started by questioning my premises about treasury policy. Brian, I had $550 million in cash, and it was yielding 0% interest. And when the Fed said, we're not even thinking about raising interest rates, the message was, for the next 4 years, you'll get 0% interest on $500 million and you'll like it. Then I started thinking, then I watched Wall Street recover. And if the S&P, if we actually look at S&P performance over the last 12 months, it's up 37%, Brian. And so if you had $1 billion and you held it in cash, you're up 0%. And if you held it in S&P index, you're up 37%. If you took the same $1 billion of cash and you bought gold, you're up minus 72 basis points. That is, you're up 0%. If you invested in Bitcoin, you're up 269%. So what is the message, right, that the world's trying to tell you? It's that we expanded the money supply. If your long-term saving strategy is put your money in a bank account as dollars or euros, then your money lost, call it 37% of its purchasing power, right? If you put your money into an ETF or S&P index, your money held its purchasing power. If you put your money into Bitcoin, it gained purchasing power. And so as a corporate fiduciary, I got $500 million. What am I going to do? Well, I don't want to hold it in cash when I know that the currency is being devalued and the interest rate is 0. That's a negative real yield. If you calculate negative real yield based on CPI, you might say to yourself, oh, it's only minus 2% negative real yield, or minus the CPI now is like 5%, minus 5% negative real yield. But if you calculate inflation based upon asset inflation, the asset inflation rate for a portfolio of companies is 37%. So your negative real yield is minus 37%. And the rule of 72 tells you that you lose half your money in 2 years at that rate.
Wow.
You lose 90% of your money in 10 years. So when the negative real yield got to minus 37%, Brian, it's kind of like you crank the temperature up in my hot tub to 250 degrees, and I jumped out. So how did I discover Bitcoin? The answer is, it wasn't a problem for me until March of 2020. It was an opportunity, but I had other opportunities, and it wasn't a clear enough opportunity that I would change my life in order to go do this thing. But in March of 2020, the big tech trade came to its end. Amazon was, $3,200 a share. Well, I wrote it from $300 a share to $3,200 a share. It wasn't going to go up by a factor of 10 or 20 from there. Apple, Amazon, Facebook, and Google were acknowledged digital monopolies and dominant networks, and every 22-year-old taxi cab driver could have told you that those were the winners by March to June of 2020. So where are you going to put your money? You can't, big tech is not like the compelling new thing. It's the understood thing. My strategy as a tech investor, Brian, is you buy something that everybody in the world needs, nobody can stop, and 99% of the world doesn't understand. And that would be the definition of Facebook in 2011 or 2012, or Google or Amazon. You could, if you go back to 2010, you could see Apple, Amazon, Facebook, Google are unstoppable. Everybody needs them. And yet 98% of the people on Wall Street would have told you when Apple doubles, you should sell some, take off the top, and you should diversify into HP and IBM and other. And when technology is more than 20% of your portfolio, you should sell technology and you should diversify into non-technology. So the diversification in that case is selling the winner to buy the losers. And of course, the idiocy is Apple became 150% of the profit of every mobile phone company in the world. Everybody else in the world lost money to compete with Apple, which made all the money. Okay. That's why you don't diversify from the category killer. Amazon won, Walmart stayed, was like a number two, and every other retailer in the world lost in that decade time frame. So selling the winner to buy the losers within the sector doesn't make any sense. And there's a certain arrogance and foolishness from a Wall Street investor that says you have too much tech exposure. You went to MIT, I went to MIT. What I observed is every growth company in the history of the world, going back to the Carthaginians versus the Romans, they were all tech companies. When the Romans beat the Carthaginians, they did it with technology. When Kraft and Heinz and Standard Oil and Carnegie Steel and Andrew Mellon, and the Aluminum Company of America, when they won, they were technology companies. AT&T, General Electric were technology companies. General Motors was a technology company. There was never such thing as an entrepreneur that took a small thing and made it into a huge thing without technology. So it's only the third generation of investors that have forgotten how the company was built that think it's a non-technology company. So bottom line, when something is no longer, disrupting the world, its growth slows down, it becomes a monopoly. When I got to April of 2020, what I said was the big tech trade is a crowded trade, and holding cash is a foolish idea. Sovereign debt is no longer a store of value. Bonds are broken. We're at the end of a credit cycle. My stock was $90 a share. I had $60 a share in cash, Brian. So I had the entire company was worth $30 a share. And the investors, when I asked them, said, cash is trash, right? Give it back to us. And so I hit this existential crisis. I had to go study. I had a problem. I needed a solution. And we were going to take one of two paths. We either had to give back all the capital, and we would have had $30 to $60 a share worth of a stock in a company with no capital base that was growing 0% a year, competing against Amazon, Facebook, Apple, and Google. Good luck with that. Or we had to invest the money in something which was going to hold value or accrete value in a monetary inflation environment. And so we did a search. We considered gold. We considered tech stocks. I already described where I thought tech stock was a crowded trade. It was already done. Buying gold was a good idea in the 19th century. In the 20th century, it's too slow. In the 21st century, it's looking antiquated. Well, I said, I want something like gold, but I want gold. I want digital gold on a big tech network. What if I could take $1 billion of gold that weighs 30,000 pounds? What if I could take that, dematerialize that gold so it moves at the speed of light? It weighs nothing. What if I wrapped it with an open protocol so I could program it? And what if I could program my iPhone or my web server to do 1 million transactions a second on the block of digital gold, move it at the speed of light, and make it brilliant, smart? And then I plug Moore's law into it, and it just kept getting smarter and faster and stronger. Well, the secret to everything that worked in the last 20 years